Welcome to this explainer. Let's jump right in, shall we? Today, we are breaking down a pretty dense Q2 2026 earnings presentation to really uncover the blueprint behind this corporate turnaround. We're looking at a company that is actively, fundamentally reshaping its financial architecture. This isn't just some boring collection of spreadsheets. It's a strategic master plan totally focused on widening profit margins, spending cash way smarter, and growing with real purpose across massive global sectors. But before we even get into the weeds, just look at this number. A massive 33.7% adjusted gross margin. This right here is the absolute bedrock of today's analysis. It represents a staggering 6.2 percentage point or 620 basis point jump year over year. I mean, when a company expands its gross margin by that much in a single year, it tells us their internal efficiency initiatives and product mix strategies are absolutely firing on all cylinders. This metric is the foundational support system that's allowing everything else in their blueprint to stand tall. Now, to truly grasp these financial metrics, we've got to anchor the data in physical reality. It's so easy to get lost in the abstraction of basis points and margins, right? But the hard work and tools driving this growth on the ground, the worker actively on the job site, that is what actually generates that 33.7% margin. It's the end user out there relying on these solutions to build, fix, and create. That physical demand, that's the true engine powering this whole presentation. So here is our roadmap for this explainer. We'll run through the Q2 2026 blueprint, tools and outdoor performance, the fastening segment, check out tariffs and inflation, look at capital and liquidity, and then finish up with the full year 2026 guidance. Okay, section 1, the Q2 2026 blueprint. Let's lay out this financial foundation. First things first, we absolutely have to define organic revenue. Why? Because understanding how it strips out currency fluctuations and sold off business units, like their recent CAM divestiture, is the only way to realize how this company achieved a 3% organic growth on $4 billion in total net sales. By stripping out the noise of exchange rates and sold off units, we get a super clear, unobstructed view of the core business's health. And let me tell you, that core health is strong. They generated $4 billion in total sales, driven by a 3% volume increase while pricing remained completely flat. Simply put, they are just selling more product. Moving right along to section 2, tools and outdoor performance. This segment is just a beast. Organic revenue here was driven primarily by the strength of power tools in U.S. retail, plus sustained professional demand in the commercial channels, bringing in over $3.5 billion in net sales, which is up 3% year over year. This segment is, without a doubt, the undisputed heavyweight of the company. It's actually really fascinating to see that both power tools and the broader U.S. retail market have bounced back to solid year-over-year growth. It shows us that demand at the job site for both consumers and pros is incredibly resilient. But here's where it gets really interesting. Look at this 11.8% adjusted segment margin. That's actually up 3.8 percentage points year over year, entirely thanks to gross productivity gains. This proves they aren't just selling more tools, they're doing it way more efficiently. It's honestly a lot like finding a way to bake the exact same size pie, but using significantly less flour, Favorable product mix and strict internal productivity measures are letting them capture so much more value from every single drill and saw that leaves the factory. All right, on to section 3, the fastening segment and divestitures, especially looking at the post-CAM landscape. In total contrast to the sheer size of the last segment, Engineered Fastening delivered an even higher 13.0% adjusted segment margin. This was propelled heavily by automotive growth that straight up outpaced the broader market. So while this segment is definitely smaller in total volume, generating about $396 million in net sales, it punches way above its weight class in profitability. By securing broad-based strength across global industrial markets, this division expanded its margin by an impressive 220 basis points. Now, here is the crucial dichotomy we need to understand. The recent sale of their CAM unit caused an 18% drop in net sales on paper, but underneath that, the core business still grew organically by 3%. If you only glanced at the top-line revenue drop, you'd probably think the segment was struggling big time. But when we apply that definition of organic revenue we talked about earlier, we see the exact opposite. The core fastening operations are growing efficiently. They essentially shed a part of the business to become leaner and hyper-focused on higher-growth automotive and industrial applications. Section 4, navigating tariffs and inflation. Let's look at the macroeconomic weather outside the building. We really have to ask this critical question to neutrally unpack how incredibly complex trade policies interact with corporate profitability. For global manufacturers, sudden changes in trade rules and the rising costs of raw materials, those are constant forces of gravity they have to fight against every single day. And this illustrates the math perfectly. Refunds from temporary tariffs essentially acted as a financial shield against the rising costs of raw materials. When you've got inflation hitting crucial components like battery metals, tungsten, oil derivatives, that could have easily eaten their profits alive. But their strategic tariff refunds basically canceled those price spikes out. It's a really powerful reminder of how operational agility and active engagement with trade policies can totally protect a company's bottom line. Next up, Section 5, Capital Allocation and Liquidity. How are they reinvesting for the future? They're operating on three main imperatives right now: giving their brands purpose, running their factories efficiently, and speeding up innovation. They are not just letting cash sit idle in a vault, they're actively putting it to work to solve end users' real problems, all while keeping their balance sheet rock solid. By activating brands, pushing operational excellence, and accelerating innovation, they are making sure every single dollar spent fortifies their position in the market. You can see this highly focused capital strategy right here. They took the proceeds from selling off that CAM business and immediately prioritized paying down debt. By wiping out $1.7 billion in debt, they drastically reduced their risk profile and future interest expenses. Boom. At the same time, using $250 million to buy back shares sends a huge signal of confidence to their investors, creating immediate shareholder value without overextending themselves financially. Finally, Section 6, Full Year 2026 Guidance. Let's look at the future skyline. This table consolidates their forward-looking guidance, confirming some really strong free cash flow targets that will let them keep investing in growth. Earnings per share are projected to be robust, sure, but I really want you to focus on that bottom row, $800 million to $1 billion in free cash flow. That right there, that is the absolute lifeblood of long-term success. It means they'll have the liquid capital on hand to continually support their dividend, buy back more shares, and fund the next generation of innovative products. Their massive outperformance in the first half of 2026 provides a high degree of confidence that they can actually maintain this impressive 34 to 35% margin trajectory through the rest of the year. They aren't expecting a sudden drop-off. By maintaining these efficiency gains and really carefully managing their product mix, they're clearly positioned to achieve their long-term target of 35 to 37% adjusted gross margins in the years to come. So as we wrap up this explainer, I want to leave you with this final question. Is this quarter's margin expansion just a temporary tariff-driven bump, or are we looking at a permanent structural shift in their earning power? We've seen incredible productivity gains, really smart divestitures, and massive debt reduction today. But we also saw how tariff refunds provided a super timely shield against inflation. As you process this Q2 2026 blueprint, I highly encourage you to look closely at their core operations and decide for yourself how high this new foundation will take them. Thanks so much for joining us for this explainer today.